Hey, I hope you and your families are doing well. In this video, I'm going to take you through a powerful trading concept that I learned from billionaire hedge fund manager Toby Crabell, who wrote the book Day Trading with Short-Term Price Patterns and Opening Range Breakout. Now, to help illustrate the concept, I will take you through my NVDA trade and my Coinbase trade thus far. You can see my account equity curve for the last 1 month from the 12th of May to the 12th of June, which is the time that I'm filming the video. And the key concept is this: from periods of contraction come expansion, from periods of expansion come contraction. So to help illustrate the point and how I apply this in my own trading, I'm going to dive into the charts of NVIDIA and also Coinbase. MarketSurge are today's video sponsor. They are my go-to resource for analyzing company fundamentals such as EPS estimates, earnings and sales. If you're interested in a discounted trial, then you will find a link in the description and the comment section below. So we're going to start off with NVIDIA, as it's a bit more of a textbook example. You can see the cup and handle there. You can see the tightness in the blue zone. You can see how the volume dries up in that zone as well. When we go on to Coinbase, that's going to be more advanced. There's going to be more nuanced concepts coming at you for how I apply this principle of from areas of contraction come expansion. So let's start diving into it. Now, there's 4 main parts of every single trade. Whether you are a scalper, a day trader, a swing trader, or a position trader, there are 4 parts to every single trade. Number 1, how do you identify what you deem is a high quality setup? Now, this is where I apply the principle of from areas of contraction come expansion. Then I'm looking to play the expansion. Now, the areas of contraction also help with the second part of the trade, which is controlling risk, looking for those asymmetric risk to reward trading spots. So I like those tight areas of contraction. And then number 3 is the risk mitigation. So if from areas of contraction come expansion, I'm expecting expansion in price. Can I then free roll the trade? Can I mitigate the risk that I have on the trade into that? You can see that's why I'm selling part of the position there. And then number 4 are what are the selling rules, selling guidelines that you are using to optimize profits, both in terms of monetary gain but efficiency of the monetary gain. So that's the time value element. So you can see how we really think through trades in terms of identify, control, mitigate and optimize. And at the time of filming this video on the 12th of June, before the market is open, I still have a position in NVIDIA. So you can see this cup and handle type pattern, right? So this is the point that I'd like you to take away from the video. This is more of a textbook one, right? So NVIDIA for me is a tier 1 TML type stock. It's the institutional stock in the market right now. So when it is basing and around a clustering of key moving averages, on my chart, black line is the 10-day EMA, blue line is the 21-day EMA, and the purple line you see there is the 50-day SMA. So when you get the real leaders in the market, the kind of tier 1 institutional type stocks, when they are basing like this and you start to get cup and handles or areas of contraction from common continuation type patterns, I want to be hyper aware of that. So you can see the tightness in price that NVIDIA is trading in a relatively tight range for maybe about 6 sessions, around about 5 or 6 sessions in this blue zone. It's trading tight and the volume's drying up. So if you want to try and understand this from a supply and demand perspective, tightness in price and low relative volume, the way I interpret that is there's a bit of an equilibrium in the market. There's not too much buying, there's not too much selling. That's what I want. Certainly if it's at the end of like a cup and handle, a VCP, a Davis box, a wedge, a pennant, a flag, all of those good stuff, these are the things I look for. This tightness in price and the volume drying up. But then what I find is useful is to use certain moving averages as a reference point. So the 10-day, the 21-day and the 50-day SMA. Around those moving averages, that's where I'm looking for the tightness in price, okay? I'm not necessarily looking for price to get really, really tight up here and you're like, well, it's just traded really tight for like a couple of sessions. I'm not looking for that. Short-term makes extended from the 10-day EMA. So I like to get initial stop losses underneath the 10-day EMA and still controlling the risk relative to the stock's 20-day average daily range percentage. I like it to be half to 2/3. Sometimes it's a little bit more if I'm trading more so a shakeout demand tail or a gap down reverse bar. But the key concept that I want you to take away from this NVIDIA chart is looking for these areas of contraction. Basically a mini Davis box. I'm sure many of you would have read Davis's book, okay? Looking for that mini Davis box, that mini little area of contraction. Maybe it's 5 sessions or so, because then if you've got 5 sessions just trading tight sideways and low volume on the weekly chart, obviously 5 sessions make a week, assuming there's no bank holidays and things like that. On the weekly chart, you're also going to get a tight weekly bar on low relative volume, because as we're trading and we're thinking about trades like this from an identification standpoint, we want to have awareness of both ourselves, but we also want to have awareness of what we think other market operators are going to do. If you're the last person buying, you're going to get stopped out quite quickly. You need other traders, other market operators willing to pay a higher higher price than what you just paid for whatever stock you were trading. Okay, you need them buying after you, willing to buy at a worse price, willing to buy at a higher price. So you've also got to have awareness of yourself and what you're looking to target, but is this going to be on other people's radars? Is there a reason why other traders, other market operators are going to be buying this? Now, from a technical perspective, yeah, there's a really good reason here. Okay, it's a textbook cup and handle, tightens up, nice week. You get the volume drying up, sitting on a clustering of 10, 21, and 50, and the fundamentals for NVIDIA are just scuba duper good, right? Sorry about that, I had someone call me mid-video. So let's get back into it and summarize the chart here of NVIDIA, thinking about the four main areas of a trade and linking it back to the concept of from periods of contraction come expansion. So when we're looking at the identification, you've got to be aware of the type of stock you're trading. NVIDIA is the #1 institutional type stock. So when it's tightening on a clustering of the 10, 21, and 50, and the volume's showing up like this, it's going to be on a lot of traders, a lot of market operators' radars. So not only am I identifying a spot in which I think the stock could move quickly through, because from areas of contraction come expansion, I can also get a tight initial stop loss, and then if that expansion is going to happen, I'm expecting this to be on a lot of traders' radars. I'm expecting that they are willing to pile in here as well and pay a worse price, pay a higher price than what I did, so I can free roll into that expansion. I can remove the risk, and then I can sit and play the stock along, say, the 10-day, the 21-day, maybe keep some back for the 50 in terms of optimizing the profits. So hopefully that's useful in terms of how I think about charts there on NVIDIA. Let's go over to Coinbase, where we're going to go a bit more advanced and a bit more nuanced. So now I'm going to take you through my Coinbase trade thus far, and this is where this video is going to get more advanced and more nuanced. So let's first and foremost think about the character of the stock. So for me, I like to study stocks and try and understand their behavior. So we want to understand, how does a stock base, how does it trend, how does it move? So if you take a look at Coinbase, okay, we're not even going to look at the entry yet, and then this is the 1 hour chart where we're going to go into some multiple time frame analysis to help further illustrate the point of from periods of contraction come expansion. If you take a look at Coinbase, we have a couple of areas, okay, where the stock has been basing and then it just trends. The stock bases and then it trends. The stock bases and then it trends. But what do you notice about these basing areas in these blue zones here? It's a little bit choppy, isn't it? It's not kind of your textbook like Menavini VCP, where it's just like this and everything looks like a textbook and it does this and it breaks out and it's all just tickety-boo. It doesn't look like that, does it? If you look at how Coinbase likes to move and how it likes to set and how it likes to trend, it basically chops around in these blue zones, chops around in these blue zones, chops around, and then it just goes on these really powerful trends, staying above the 10-day EMA and the 21-day EMA for the vast majority of the trend. So this is then linking into the stock's character, links into how I think about, how do I want to identify a setup in this stock? How do I want to control the risk? How do I want to mitigate the risk? How do I want to optimize the profits? Well, actually, if you were to look here, I'm going to digress from the video a little bit, and I'm going to talk about optimizing profits, selling rules, selling guidelines. If you look at where is the close for the 50-day each time, closes here, okay? Closes here, closes over here. So imagine if you were buying in here on this breakout, you were buying in here on this breakout, or you were buying in here on this breakout. Is the 50-day an optimal selling guide relative to, say, the 21-day EMA or the 10-day EMA? See, the 21 is up here, the 10 is up here, okay? The 10-day EMA is there, the 21 is over here. So this is where you can start to understand the character of the stock. Sounds a little bit woo-woo, sounds a little bit out there, right? But this is how you build that framework around the stock. You have an idea of how you want to trade, how you identify, how you control, how you mitigate, how you optimize. But I will then let the stock have the ultimate say for what I think is optimal based on the character of the stock. The 50-day, I don't think is going to be optimal relative to the 21 and the 10-day as trailing stops for Coinbase when it starts moving. Okay, that's how I kind of think about it. So as I'm trying to get positioned in Coinbase here, I'm then going, okay, if it wants to start trending based on the previous 3 times the stock has trended, the 50-day is not going to be an optimal selling guide relative to the 21 or the 10-day. If you're thinking both in terms of optimizing profits from a monetary gain standpoint, but also an efficiency of the gain, which is the time value of the stock. So just remember, as I'm then targeting Coinbase down here, and you may be like, why are you targeting Coinbase there? Well, if you watch some of my other videos, you'll be familiar with gap down reversal bars, shakeout demand tails, and Coinbase likes a shakeout demand tail. And what you saw from the previous way Coinbase set up before it trended is it tended to chop around. But I think there's some subtle clues in there if you know what you are looking for. But let's get on to the concept of how I then apply multiple time frame analysis. So this bar here that you're going to see, this is the 1 hour chart for this session. So I'm not just looking for areas of contraction on the daily chart and say the weekly chart, I'm also utilizing multiple time frame analysis such as the 1 hour chart. So if I now pull it across like this, okay, so when I identify a setup on the higher time frame. That could be what I call a trigger bar. It could be a gap down reverse bar or a shakeout demand tail. I like looking on the 1 hour chart. Now, there's a couple of things that I'm looking for, and I like looking for those institutional footprints. So if we start zooming in here, okay, over here, you get a gap down reversal bar. I like that, okay? It's actually marking the low as well. Nice gap down reversal bar. Prior close here, gaps down, opens up, turn around. Large operators, most active in the 1 hour, on the first 1 hour. But for me, a lot of trading is about trying to identify the spot in which you think the stock is going to move quickly from. You're trying to identify that point on the chart where you're like, wow, price could explode through here. And remember, it's got to be on other people's radars. You need them willing to pay a worse price than you. Okay, I'm buying at 210.74. I need traders, market operators willing to buy at 212, 214, 216, 218, 220 if I'm going to have a profitable trade and this thing is gonna trend. But let's get into it, right? So when I'm then looking on the 1 hour chart, I like having these three moving averages on my chart, which is going to be the black line is the 10 EMA, the blue line is the 21 EMA, and the purple line that you see is the 50 SMA for this time period for the 1 hour chart. Okay, so these are different to the moving averages that you'll see on the daily. I like the close convergence. Now, why is that? Again, think about the principle, the concept of this video. From areas of contraction come expansion. I like that contraction, not only in price, but of the moving averages as well. Okay, see how the moving averages converge. You see how here they're just kind of spread apart, spread apart, spread apart, but there you start to get the close convergence, and it's setting up, if you know what you're looking for on the daily chart, it's setting up and it's looking really constructed. So then when we start breaking down this final session, shakeout demand tail, nice rally, little pullback in there, note how the volume dries up, and then look at the last 3 hours, certainly the last 2 hours. What do you notice? Contraction, contraction, volume drying up. You see it? And it's sitting on a clustering of those moving averages on the 1 hour chart. So we're trying to combine multiple concepts, multiple things across multiple time frames. Okay, and then I'm buying it in here, and then I want traders willing to pay a worse price than what I paid, so then I can free roll into it, sit through the test, and then try and play the stock for a bigger move, as I'm an intermediate term trend follower. So I will try and pinpoint these entries, remove the risk, and then sit and let the intermediate term trend play out. That may be 5%, I may get stopped out 5 minutes later, it may go 50%, 500%, no idea. Nature of the beast, lady luck, and variance. So I really hope you guys have enjoyed that video. You've learned a couple of things there in terms of the principle of contraction and expansion, how I apply it to my trading, utilizing multiple time frame analysis as well. So thank you very much for watching. Thank you for supporting the channel. If you haven't subscribed and you like these videos, please subscribe for more videos like this. And as always, I look forward to seeing you in a future video.